Not quite the right numbers for Roku, though, getting crushed following earnings and on pace for its worst day ever. The streaming stock missed earnings estimates, citing macro headwinds. And now analysts are weighing in. It got downgraded to inline at Evercore and neutral over at Susquehanna. It's one of our calls of the day. Jim, you have owned it in the past.
Yeah, Frank, I have traded it in the past, which is not what you know me for. It's not what Bryn or anyone knows me for. But this was actually years ago where the momentum in this thing was just so outstanding that I just decided to ride it, had a little fun, talked about it on the show, but never on a fundamental basis did I own or invest in it. And the reason why is because of what we're seeing today. At the time, a few years ago, it was trading at many turns on a price-to-sale basis, about 25. Today, it's down to 2 times after this deluge, from the 400s to 63. And still, it's expensive when you measure it on earnings that are not going to come for a few years. And free cash flow that is starting to appear, but you're still measuring that in the 80s. Frankly, the summary of this is it's simply too expensive. Now, it's a cool company, and what they're doing is fabulous, but this is a lesson for everyone. Price matters. Valuation matters. It's that simple. And you can say it didn't matter, but it does until the Fed gets aggressive, which is exactly what's happened this year to Roku and to all of the similar stocks like that.
So, Bryn, cool company maybe, but is this maybe the final nail in the coffin for that work-from-home pandemic play?
Well, no, I think it's to Jim's point, when you have the Fed tightening and you have that shift, this is like Snapchat or Snap. When you have no G, growth, and you have no E, earnings, and then you guide down and you miss on earnings and revenues, there's no place for that company in the market today at the price it was the day before. And so it's not surprising it's down 25%. I think that streaming service also, all of those stocks have come down, whether you're Netflix, Disney, Paramount, and then Roku, which obviously aggregates a lot of that. They've all come down, but they all have different levels of value, right? And so I think Roku is, to Jim's point, it's actually a great company and it's a good story, but how do you value the company right now when that G, you can't get comfortable around the growth of that to try to value the lack of E.
Yeah, good point there. All right, turning our attention to Northrop Grumman, up 3% right now, upgraded to outperform at Baird. The firm saying the setup remains very attractive in 2023. Jim, I know you don't own Northrop, but you have exposure to that space via Raytheon.
Yeah, and I think we're going to get a lot of agreement here that defense, aerospace, but particularly defense is the place to be. Defense budgets around the world are going to do nothing but go up. Northrop Grumman, I owned it until late last year. It might have been early this year, excuse me on that. And this is where you want to be. Now, I'm in Raytheon, which takes the place of Northrop in the same way. Missiles, space, aerospace. These are the areas that you're going to see growth going forward. For those who are thinking about getting into Northrop, I would simply say it's got to go through a little consolidation phase here before it sets the next leg up. So that's why you don't see me rushing back into it. Let's let this consolidation of these massive gains this year take place, and probably near the end of the year we can get back into it.